So why in the world are we digging up a shareholder letter from 1987? I mean, that was a lifetime ago in market years. Well, because in today's world of high-speed trading and just constant noise, this letter isn't some dusty old document. It's a masterclass. It's a practical playbook for navigating any market in any era. What Warren Buffett laid out back then is, frankly, a powerful antidote to the craziness we're all dealing with right now.
Okay, let's dive right in. Here's how we're going to tackle this. We're breaking down the letter into 5 core ideas. We'll start with how Buffett actually figures out what a business is worth. Then, we'll get into his mindset on ownership, cover his legendary framework for dealing with market psychology, and look at the kind of boring businesses he loves. And finally, we'll see how it all clicks together into a real, repeatable philosophy.
First up, we have to talk about the most fundamental distinction there is in investing. It's the very first thing Buffett brings up in the letter, and it's this huge gap between an accounting number and what a business is actually worth in the real world.
So the big headline number for 1987 was a 19.5% gain in net worth. Pretty good, right? A solid year. But Buffett immediately tells his shareholders, hey, hold on. Don't get too excited about this number. He says this figure, the gain in book value, is not what really counts. He's pushing them to look way, way deeper.
And here it is, the crucial point. Book value, that's just an accounting number. It's a historical figure. But business value, what Buffett calls intrinsic value, that's the real economic truth. It's basically the discounted value of all the cash a business can spit out for the rest of its life. You know, the examples here, like LTV going bankrupt with a huge book value, or Bill Ridge Oil selling for billions when its book said millions, they're just stark reminders that the market eventually wakes up and prices for reality, not for accounting fiction. That's the whole game.
So this focus on true intrinsic value flows right into his philosophy on ownership. Because once you really get what a business is worth, you start to appreciate what actually creates that worth. You know, exceptional companies run by exceptional people.
And Buffett doesn't just talk theory here. He points to what he lovingly calls the Sainted Seven, his core group of non-financial businesses at the time. These are the actual engines that were cranking out all that real business value we were just talking about. And get this. This number just brilliantly illustrates their quality. As a group, these 7 businesses were generating an after-tax return on equity of about 57%. 57%. And they did it with hardly any debt. Why? Because they were fantastic, capital-light businesses with killer competitive advantages. I mean, he points out that of the 1,000 biggest companies back then, only a tiny handful had managed an ROE over 30% for the past decade. So this wasn't just good, this was absolutely world-class.
So you have to wonder, what's his role in all this success? He says it's applause, but listen to how he describes it. It's informed applause. He's not just a cheerleader. He's someone who spent a lifetime studying businesses. He's not meddling. He finds these incredible managers, gives them the capital and freedom they need, and then he just gets out of their way. It's simple. Buy into great businesses and trust great people to run them.
Okay, this brings us to what might be the most famous lesson from any value investor ever. If you own all these wonderful businesses, how do you stomach a market that's constantly repricing them, a lot of the time completely irrationally? Well, Buffett gives us the perfect mental model.
He wants you to imagine that you don't just own stocks. Instead, you're in business with this one guy, this very emotional partner he calls Mr. Market. And every single day, this guy shows up and offers to either buy your shares from you or sell you his at a specific price.
The thing about Mr. Market is, his behavior is totally manic-depressive. Some days, he's just euphoric. He sees nothing but blue skies and names a ridiculously high price for your shares. On other days, he's completely depressed, convinced the world is ending, and he'll offer you his own stake for practically nothing. The absolute key here is to realize his prices are driven by his emotional baggage, not by the real value of the business.
And here it is, the punchline. You should never, ever let his mood dictate what you do. He is there to serve you with opportunities. When he's depressed and quoting you a silly low price, you can buy from him. When he's euphoric, maybe you think about selling to him. But you never, ever take instructions from him. You're there to use his pocketbook, not his wisdom. You take advantage of his foolishness, you don't join in.
Okay, so you've learned to tune out Mr. Market. Where do you actually put your focus? Well, Buffett argues it's in the places most other investors are actively trying to avoid.
He uses this fantastic analogy. He says so many investors are dreamers, just chasing the thrill of the new thing, the exotic, the high-tech blind date.
They get so caught up in the promise of massive change that they completely ignore the steady, reliable, and incredibly attractive girl next door, that proven wonderful business that's sitting right there in front of them.
And he backs this up with hard data. He points to this Fortune study of the best-performing companies over the last decade. And what do these superstars all have in common? Well, for the most part, they were boring. They sold simple products, used very little debt, and were basically doing the same thing they were a decade earlier. It's proof that amazing returns come from durable, predictable businesses, not from constant disruption.
All right, let's bring this all home. How do all these principles, focusing on business value, thinking like an owner, using Mr. Market, and loving boring businesses, how do they all combine into a concrete, actionable investment strategy?
Buffett points out something that's really a key advantage of owning a business outright. You get control over capital allocation. Think about it. Most CEOs get to the top because they're great at sales, or marketing, or engineering. They're great operators. But then, their number one job becomes deciding where to put the company's cash. It's an investing job, and it's a skill they might have never actually developed. And this, he says, leads to a whole lot of unintelligent decisions in corporate America.
So, that insight then shapes Berkshire's entire financing strategy. He prefers to borrow money when it's easy and cheap to get, not when he's desperate for it. Why? Because the truly massive opportunities, those rare, fast-moving elephants he talks about, they always seem to pop up during a crisis, exactly when money is tightest for everyone else. By planning ahead, he makes sure his gun is always loaded.
And all of this culminates in his famous acquisition checklist. Just look at it. Every single principle we've talked about is baked right in here. He wants consistent earning power, not some turnaround story. He wants good returns on equity with low debt. Simple businesses he can actually get his head around, with a great management team already running the show. This isn't just a list, it's the entire philosophy, made real and actionable.
And so that leaves us with this question. Here we are, more than 3 decades later, in a market that feels infinitely faster, infinitely more complex. Which one of these simple, powerful ideas is the most important one to hold on to today? Is it the discipline to see the difference between book value and real business value? The patience to ignore Mr. Market's daily screaming fits? Or maybe the courage to invest in that brilliant, boring girl next door? That's really the challenge this timeless letter leaves with all of us.